Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I Tell.
All right. Hey guys, it's Mark Itel here, and this is the Mr. Mortgage Show. And guys, you are in the right place. We have an awesome show lined up for you this week. We're going to give you all of the information, the tips, the tricks, the strategies, the answers to your questions so you can go out and make better real estate and mortgage decisions for you and your family. And we are going to deep dive and debunk all the crazy headlines, the Instagram and Facebook and TikTok dancing realtors and mortgage brokers and the silly memes out there about how a crash is coming, a housing boom is coming. Now's a great time to sell. It's crazy, right? It's crazy. Guys, there's so much information out there. And most of it is garbage. It's ridiculous. You know, right now, the hot topic is interest rates. And it has been for the last few months because you've seen all the posts. Interest rates are on the way down. The Fed's going to cut. We're marching downward, 5 cuts. And everybody's saying that except the Fed. The Fed keeps saying, wait a minute, guys, there's still economic data being released pretty regularly that indicates the economy is far too hot for that to happen. And that's who you need to pay attention to, not the cute real estate agent on social media. They don't have any power over interest rates, only the Federal Reserve. And truth be told, we talked about it last week, the Fed has very, very little influence on mortgage rates. And to illustrate that point, I referenced last week that at the beginning of 2023, interest rates were about where they were at the beginning of 2024. Yet at the beginning of 2023, the Fed funds rate was 1 full percentage point lower. So if you think the Fed rate directly influences mortgage rates, that alone right there indicates that's not the case. So guys, the Fed has said on more than one occasion and reinforced that this week, they do not anticipate cutting rates anytime soon and not at the pace that everybody is shouting from the rooftop that it's going to happen. And guys, if you're waiting on interest rate to make a decision, you're kidding yourself. You're not ready to make a decision because whether rates are 6 or 6.5 or 6.875, the fundamentals of your purchase decision shouldn't change. Maybe the property changes a little bit, but the fundamentals of the decision shouldn't change. Rate alone is not the most important number in the transaction, and we say it all the time. If you're waiting on rate, you're not going to do anything anyway. You're kidding yourself. You might as well renew your lease. Rate's not the only reason, and rarely is it the right reason to make a move because you're just trying to capitalize on a moment in time, and you're not doing it fundamentally for the right reason. So anyway, we can talk about that again this week if you have questions. We went over that last week in length. So I did want to touch on that, though, because rate seems to be the question of the day. And the answer to the question, are interest rates going up or are they going down? The answer is yes. Guys, think about being at the beach and you've got your chair in the sand and you've got your toes in the sand and you're sipping on the cold drink and you're looking out at the water. And all of a sudden your feet get wet. And you're like, oh, wait a minute. Is the tide coming up? Should I move my chair? And you look down and you can tell by the line in the sand where it's wet that the water is moved up right to the edge of your chair. And you're thinking, uh-oh, here we go. Rates are going up. I better move my chair. And then the next wave comes up, not quite as far, doesn't really get your toes wet, and then recedes a little bit farther than the previous wave. And the wave after that does the same thing. So as the tide is going out, waves still come up and go back and up and back. And that's what interest rates do. As they trend upward, they go up and down in that cycle, stair-stepping up or stair-stepping down. And if you're trying to wait until that plateaus on one side of the stairs or the other, you're going to miss all of the opportunity. So think about it that way. You know, I was trying to come up with an analogy. I use the beach a lot because I was born and raised in Florida, blessed to spend a lot of time on the beach as a kid. And some of my fondest childhood memories are on the beach. So I always like to use that one. But think about a crock pot, guys. Simplify your approach. This isn't, Iron Chef, and Gordon Ramsay isn't looking. None of us have any business cooking with more than a crock pot unless we have a ton of free time. Everybody's busy. They don't have the time to watch every single wave. And that's the beauty of the crock pot. You put everything in there, you set it, you go to work, you forget it. You come home, there's a beautiful meal there. The alternative to that is, a dish in the oven, 3 or 4 pans on the stove top. You got a saucepan in the back corner boiling over. You're trying to watch everything. Meanwhile, nothing is done to the correct temperature or comes out at the right time. And you want to know how I know that? I cooked Thanksgiving dinner in my household last year. I pounded my chest. I was going to do it. I can do it. And a local restaurant provides a meal kit for Thanksgiving. And I thought, this is great. All I have to do is heat the stuff up. Well, yes and no. It's all uncooked, but portioned correctly, ready to be potted and cooked. And there were 6 items to be prepared. Well, that's 6 items at different temperatures that have a different cook time before they were ready to go. And I thought I was just going to pull all of this out of the box and put it in the oven and warm it up. And suddenly I realized, oh my gosh, I got myself in a little bit over my head. So I worked backwards. Hey Siri, set an alarm for 20 minutes. Hey Siri, set an alarm for 45 minutes. And I started the turkey at this time and the stuffing at that time. And yeah, it was perfect. Everything came out on time. But my God, what a major pain in the backside. And the kitchen looked like the Tasmanian devil had just rolled through it because I was not prepared. Again, not Hell's Kitchen, not Gordon Ramsay. I'm a crockpot guy. That's why 401ks and IRAs and pension plans make more sense for more people than day trading because 1, they don't know what they're looking at when they're looking at fundamental triggers, and 2, they don't have the time to do it. So the whole set it and forget it, right? The crock pot. Buy a property that you can afford, that meets your family's needs, that you're going to be proud to raise your family in, make the payment every month, and over time you're going to build equity. That's what we need to get back to. There's too many people on social media selling you courses on how to get rich in real estate. By Airbnb arbitrage, right? You're going to go out and lease a bunch of properties and then turn around and list those on Airbnb. Guys, come on, man. If these people were really getting rich doing this, do you think they would take the time to create a course and sell you a course for $397 on how to do what's made them a millionaire? No, they'd keep doing what makes them millions of dollars. So set it and forget it. Put your chair in the sand. Dig your toes in the sand, feel the nice cool water, the warm sun on your face, have a cold drink, watch the kids play in the surf, and life will be much simpler. And over time, you're going to build equity in your property. Now, if you're a real estate investor and you want to talk about cap rate and return on cash and cash on cash, we can dig into all of that. But the vast majority of people need a crock pot, not 10 pans and 6 timers and an assistant chef and a sous chef in the kitchen to help them prepare dinner. Sometimes I even make myself laugh. I just envision myself making such a mess in the kitchen trying to prepare that Thanksgiving meal. Anyway, guys, you hear the music. You know what that means. That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, we appreciate you spending a bit of your day with us. If you have questions or comments along the way, please call or text 855-462-7292. That's 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen, my producer extraordinaire, is standing by, womaning the hotline, and she will get your questions on the air. And I'm laughing because she just shared a comment that came in via the website. And if you want to shoot your questions that way, you can do it by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the screen is a big orange button that says, get your questions on the air. You can't miss it. Click that button, follow the instructions, and Jen will read your questions on the air. Someone shot a comment over via the web portal and said that I'm a bit of a mansplainer with the Thanksgiving dinner analogy. Guys, I don't mean to be. I've been this way my whole life. I think in very visual pictures, and I try to translate that thought into a word so you see what I'm thinking. And Jen's been with me long enough to know that it has very little to do with man or woman and more to do with how I think. So thank you for bearing with me. I hope that makes sense, guys. Just don't overcomplicate things, because you still need to go home every night and raise your family in a home, whether you rent that home or you own that home. And either one could be the right decision for you. You just need to evaluate it based on the correct fundamentals, because sometimes, as we talked about it last week, renting is the right way to go. Over time, if you can buy, you'll definitely want the opportunity to build equity, because, man, equity makes a difference. There are a lot of people sitting at home right now feeling pretty darn good about their future because they have $200,000, $300,000, $400,000 in equity and a 3% interest rate. They were in the position to take advantage of an opportunity, but they had previously put themselves in that position. Again, not always right for everybody. So we like to talk about the core fundamental principles to make your decision based on. But hey, with all of that out of the way, I want to dive right into your questions. They are my favorite part of the show. So I'm going to throw it over to Jen and let's get some questions on the air. Hey, Jen, are you ready to go over there?
Valerie sent us this. I'm trying to buy a house with my fiancé. He makes good money, but doesn't have a credit score. His family doesn't believe in debt. Is there a way we can use both our income and just my scores for the mortgage?
Hey, Valerie, this is a really, really interesting question. A good question, too, by the way. And congratulations. I bet he's good looking, too, isn't he, right? Makes good money, no debt, and deadly handsome. Well done, right? The trifecta of fiancés. The good news is there's a very, very simple workaround for this, because the reality is just about any loan program that you're going to actually want to use from a down payment and interest rate standpoint is going to require that you both have credit scores if you're going to use both your incomes. So, and we get that question a lot. If one person has a low score, can we use the better of the two scores in both incomes? We use the lower of the two borrowers' middle score, because everybody has 3 credit scores and both incomes. So in this case, we're going to need him to have a credit score. Now, as I mentioned, there are a couple of very easy workarounds. One is he could go down to the bank. He could apply for a secured credit card and wait a few months for it to post, and he'll start to get a credit score that way. Or if you've got credit cards that have good credit history that you've had for a while, you could add him as an authorized user, and he's going to inherit that good credit and credit score. So the fastest way to do it is to add him as an authorized user on a few of your accounts. You're still going to use both incomes and the lower of both your middle credit scores. But those are the two things that jump to mind as quick strategies to make this happen. So if you have additional questions or you need help in understanding that, just give me a call or shoot me an email and I'll walk you through the details. I hope that helps. Great question, by the way. Hey, Jen, do you have another question ready over there? Okay, go ahead.
Trevor has this question. I'm very confused. Just a week or so ago, I read rates were falling, and then this week I see they are up again. Are they headed higher from here? What do you think?
Hey, Trevor, this is what I was talking about in the opening of the show, my man. It's like that beach analogy. As the tide is going out, waves are still crashing up. And as the tide is coming up, waves are still pulling back. So if you're looking at the daily trends or the weekly trends, you're going to see those moves up and down and up and down. The overall trend has been downward, although we are seeing spikes up and then a pullback and another spike up. I think long term that we're likely to see lower interest rates. I just don't think we see 4 and 5% interest rates anytime soon. That secondary market is what's driving interest rates, and the appetite for mortgage-backed securities is what dictates the rate. And right now it's holding pretty steady in the higher sixes. And there might be days that it pulls back to the mid sixes. And then as we saw early this week, there may be days that it bumps up over 7. That's why, again, if you're looking solely at rate, you're looking at the wrong fundamental in that big equation, right? We talked about it. Set it and forget it, cook in the crock pot. And if you missed the opening segment of the show, wait until tomorrow and you can check it out at Mr. Mortgage Radio as the podcast episode, because too many people are hung up on fundamentals that A, don't really matter in the grand scheme of things, and B, we don't really understand as everyday consumers and everyday mortgage borrowers. And I don't mean that to be derogatory by any means, because a rate Monday can be 7 and a rate Thursday can be 6.75. Yes, it is definitely better to lock on Thursday, but the fundamentals of that transaction didn't change based on that interest. And if they did, you're dancing way too close to the edge anyway, because what's going to happen next year when your taxes go up? What's going to happen next year when your insurance goes up? And everybody is dealing with insurance now. So great question, my man. I wish I had a crystal ball. I really do. I think we stay in the 6% channel for quite some time. I don't see this rapid descent down into the low 5s anytime soon. And I've been the dissenting voice for the last 3 years, and it served me well. I hope I'm wrong, guys. I hope I'm wrong, because cheaper money is better for everybody in my industry. But the reality is, I think we need to base the decisions of today based on the data of today and not the TikTok predictions of tomorrow. So great question, though. I appreciate it. And you are not alone in your frustrations or confusion, because I'm having this conversation almost every day with people. It's super confusing. You've got the TikTokers and the CNBCers and everybody in between. So I hope that helped, though. Hey, guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
We're back. Hey guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. I can't believe they give me a microphone and they let me do this each week. I have so much fun each week, spending some time with you, answering your questions. I really appreciate your questions. If you've got questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the anytime hotline. Jen is womanning the hotline, and she'll get your questions on the air. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page, there's a big orange button that says get your questions on the air. click that button, follow the instructions, and Jen will read your questions on the air. Let me throw it to Jen and get right to them. Hey, Jen, go ahead when you're ready.
Here's one from Roberto. I'm a U.S. citizen and have a 684 credit score. I want to buy a house with my brother, but he's not a citizen and only has an ITIN number. Will we be able to get a loan?
Hey, Roberto, another great question, my man. I swear we've got the best listeners. You guys ask the best questions. So for anybody out there that's confused, an ITIN is an individual taxpayer identification number. When you're going through the citizenship process or you're here in the U.S. on a work visa, you don't have a social security number yet. So in order for the IRS to collect taxes, they need to issue you some sort of taxpayer ID, and that's what that ITIN is. So the good news is, Roberto, that yes, with an ITIN number, you can buy property in the U.S. Now, you're not going to get the benefit of all of the programs that you would have access to as a U.S. citizen with your social, but both of you together will be able to utilize the ITIN programs, the ITIN programs, and you could buy a property with as little as 15% down and utilize both of your documentable income. So yes, you should absolutely be able to buy a property together with your brother. And we see a lot of that in Florida in particular, where my headquarters are with the ITIN program. So if you have any questions about that or need help, please give me a call or shoot me an email and we'll set up a time where I can walk you through it. ITIN programs do exist with as little as 15% down right now. And guys, that's fluid. It may be 10% sometimes, it may be 20% other times. It depends on the appetite of the market. But right now we're seeing ITIN programs with a 15% down payment. Hey, Jen, throw me another question.
Marjorie sent this question. I've read that once we take a reverse mortgage, we can stay in our home until we die. What happens if we don't want to stay here? Can we sell the house if we wanted to move?
Hey, Marjorie, this is a great question. I don't get as much of an opportunity to talk about reverse mortgages as they warrant because right now in particular, we're seeing a lot of interest in reverse mortgages. And we have a dedicated department in my practice for reverse mortgages because they're so specialized. The reason that I initially got in the reverse mortgage space was to help a family member, and I wanted to make sure they were making the very best decisions because a reverse mortgage is not right for everybody. I say it all the time. And Marjorie, it's a tool. It's a very powerful tool that can help the right person make a significant improvement in their monthly cash flow position. But it's just a tool. It's a hammer. A hammer can build a house, but a hammer can tear a house down. But let me get to your question because this is a great one. There's a few common misconceptions, and this is one. You can sell your house. You're not locked into your house. You're not locked in. You're able to stay there until your death if you wish. You can sell the house. You can refinance the house. What you can't do is move out and rent the house out because it has to be your primary residence. There's strict rules, regulations, and caveats around the primary residence. But as far as selling the property, not a problem. As far as leaving the property to your heirs, not a problem. You own the home. That's another misconception. You don't sign the property over to the bank and then they grant you the ability to live in the property till your death. It's your property. Now, there's a lien on the property like any other mortgage debt has a lien associated with it. The big difference is you don't have to make a monthly payment. And this is another misconception, and it has to do with the way the program is marketed. You still have to make a payment. It's just one big payment at the end. They don't collect a monthly payment, but that interest accrues over time. It's designed to allow you to have access to your equity and use that equity to subsidize your monthly cash flow to better your lifestyle, make it easier for medical expenses and groceries and in-home health care and all the things that we may or may not struggle with as seniors, especially fixed income seniors who've lived through this recent inflation cycle. It's an amazing loan program, but it's not free money, guys. There is a big payment due at the end when you die or when you sell or when you refinance the property. And when you leave the property to your heirs, they have to either sell the property or refinance the property to satisfy that mortgage lien, just as if you passed away with a normal mortgage on your property. So great question. I appreciate it. I hope that helps. And if anybody out there has reverse mortgage questions, please call us, text us, email us, or better yet, go to MrMortgageRadio.com, and there's a button down halfway down the page or so, 3/4 of the way down, that says more about reverse. There's a little explainer video, and you can request more information there. There's no obligation. We just want to help you understand the program because, as I mentioned, it's not right for everybody. Even though a lot of the advertising indicates that it is, you need to understand the good and the potential bad of the program. So I always enjoy these questions, and I appreciate that. Hey, Jen, do we have another one? Go ahead.
Ryan emailed this one. During COVID, I had 2 late mortgage payments. I didn't file for the moratorium, and I did catch them up. It's been almost 3 years since this happened. Will this prevent me from getting a new mortgage?
Hey, Ryan, another good question, my man. I appreciate this one. So with 2 mortgage lates more than 24 months ago, you'll be fine. And congratulations on getting them caught up and not going through the moratorium. Not that I have any judgment against people who went through and used the eviction moratorium and the foreclosure moratorium. I get it. There were a lot of people who suffered, but there were also a lot of people who rode that gravy train. So yeah, congrats for getting that squared away, and enough time has elapsed that you will likely be fine with a variety of loan programs. I hope that helps. We get that one a lot. There are questions regarding how recently after foreclosure, how recently after bankruptcy, how recently after late payments, either credit cards, cars, or mortgages. And obviously mortgage payments weigh the heaviest out of those 3: car payments, credit cards, and mortgage payments. But the good news is the more time that's expired since the event and now, and you've reestablished. And the good news is that COVID is a very, very valid reason for having late mortgage payments, car payments, or credit card payments. The entire world's income was interrupted during that. Can you believe that that was what? COVID-19. That's 5 years ago or 4 years ago, really, since the teeth sunk in. I can't believe how much time passed because I still go to the hardware store and try to buy something and they tell me, well, it's shipping delays because of COVID. I'm thinking, how long are we going to use this COVID excuse? But it's hard to believe that that was well over 4 years ago. But Ryan, my man, that's a great question and you are in the clear. And if you need help with that or additional info, you know how to reach us. But hey guys, Jen is playing our song. You hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And you heard the man. The anytime hotline is 855-462-7292. That's 855-462-7292. You can call or text your questions to that number. And Jen is standing by, womanning the hotline. She'll get your questions on the air. If you prefer to do it online, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button right under my ugly mug. It says, get your questions on the air. If you click that button, follow the instructions. Jen will read your questions on the air. But speaking of Jen reading questions, let's throw it her way.
Julia has this question. I'm confused. I keep seeing a new loan for only 5% to buy a quadruplex. But when I do a Google search, it looks like they all require 20% down. What am I missing?
You're missing nothing other than you're being influenced by confusing and misleading social media posts. We talked about this a few weeks ago because this one's been driving me nuts. Back in November, Fannie Mae and Freddie Mac, which are the two government GSEs, which they set the rules, if you will, for quote-unquote conventional loans. They changed the guidelines on 1 to 4 unit properties, requiring as little as 5% down payment. Now, they're following in the footsteps of FHA, which has done this with as little as 3.5% down. And you're saying, wait, Mark, but FHA is only for people who are going to live in the house. Well, so is this loan program. It's being presented as a program for investors, but it's not. It's a primary residence loan program for investment properties. So if your goal is to live in one of the units and rent the additional units out for income, you're going to move into one and have 3 income streams, which is a brilliant, brilliant strategy. Then this is a loan program that may work for you. But there are a lot of other caveats. If you've had rental experience before, or you've had at least monthly payment experience, meaning you've rented or owned in the past, it's a primary residence purchase of an investment property. Now, as I mentioned, FHA also has a program that will allow you to buy a 4-unit property. And a lot of people are using this as a strategy to buy a rental property and in a year, 2, 3, 4 years down the road, move out of it, rent that unit that you've been living in out. Now you've got additional income and going and buying a quote unquote regular house and starting to build an investment portfolio that way. But it's not that suddenly you can become a real estate investor with as little as 5% down. You can if you're buying it as your primary residence. So if you're Googling 4-unit mortgage requirements, I don't know what you're Googling, but it sounds like that's what you're looking at when you're doing the research. You're going to see 15, 20, 25% down programs. The good news is there are the landlord loan programs that we have, right? We talk about the landlord loan all the time with as little as 15% down. But that primary residence program is FHA 3.5%. Or conventional 5%. So I hope that helps. You are not missing anything. Hey, Jen, throw me another one.
Monica sent this. I got stuck with a bunch of debt in my divorce. I'm not complaining. I'd rather have the debt than my ex. Can I use the rec refi to pay off these joint debts, even though I'll be the only one on the mortgage?
Hey, Monica, that's a great question. Yeah, I think there are a lot of people that would rather have the debt than their ex. You can accomplish this. Absolutely. You can do the rec refinance and pay off these debts that you're obligated under the marital settlement agreement or the divorce decree to pay. And this isn't uncommon, guys. So maybe you ended up with the house, but because you got the house, you also got these debts. So you're going to refinance the house to pay these debts off. And, you know, he's one more time going to be lucky by knowing you because you're going to pay off these debts. But yes, you can do it even though they're not solely your debt. And he absolutely doesn't have to be an owner or a borrower on the rec refi in order to make that happen. So I think I understood the question. We see it all the time. And it's doable, absolutely doable with the rec refi. So I hope that helps. If you want more information regarding that particular loan program, you can go to recrefi.com or head over to mrmortgageradio.com and there's a rec refi button. You can use the calculation tools. It explains everything. But great question. I hope that helps. And congratulations on ridding yourself of the ex and soon to be ridding yourself of his debt. I appreciate that one. Hey, Jen, throw me another one.
Kirby sent us this. What is the minimum down payment and minimum cap rate for the landlord loan on a 4-unit apartment building purchase? Thank you.
Hey, Kirby, you sound highly researched, my man. Cap rate is not considered with the landlord loan because honestly, cap rate can be manipulated. You can manipulate the cap rate based on the admin costs for running the property. There's all kinds of factors that go into cap rate. So to simplify it, we use the debt service coverage ratio. So we're looking at the gross rents collected against the monthly mortgage expenses. And those mortgage expenses include principal, interest, taxes, and insurance. So we're looking at a debt service coverage ratio. And as long as it's at least 1-to-1, meaning the amount coming in matches or exceeds the amount going out, then there are loans available under the landlord loan program. The higher the coverage ratio, the better, and you'll want that as well because you're going to want to make a profit on the deal. But there's no cap rate calculation in underwriting the landlord loan or a DSCR loan. It's debt service coverage ratio, and I can help walk you through those numbers. But great question, my man. I appreciate it. Hey, Jen, let's keep them rolling.
This one is from Cheryl. This is an insurance question. My policy just jumped, and I can't find a cheaper quote. I know you've said our bank requires a minimum amount of coverage. We've checked, and we can't lower it. But what if we increase our deductible? Will that work?
Hey, Cheryl, no, it's not going to work. And let me tell you why. Here's the challenge with your strategy. And I love that you're thinking outside the box. And I want to cover a few fundamentals. So you mentioned that you're aware that the lender requires the loan amount or the full replacement cost of the property be your coverage amount, whichever is less. So if you owe less than it costs to replace it, no problem. You can lower your coverage, and oftentimes that will save in the premium. Now, you may be underinsured, but you're meeting the requirement of the lender. And if your goal is simply the monthly payment, a lot of people go that route. I don't like the fact that people are underinsured, but I see people do that. The other thing that they think about is, wait a minute, what if I just jack my deductibles way up? That's got to reduce my premiums, right? And it does, because the risk is less to the insurer. Because if you've got a $2,500 deductible, or you've got a $25,000 deductible, that's a huge difference on a $100,000 claim. So suddenly the insurance company's risk goes down, but the mortgage company's risk goes up, because on that $100,000 claim, there's only $75,000 worth of coverage. So there are maximum deductibles that are allowed by the loan programs, and they vary. You can't exceed a certain deductible and still meet the requirements of your lender. And guys, if your insurance doesn't meet the requirements of your lender, you risk being force placed. And if you think policy premiums jumping on the open market are scary, force placed insurance can be super, super expensive. And force placed simply means the lender chooses the insurance company. They often own an insurance company or have a subsidiary, and boom, now you've got a very, very expensive policy. So you want to avoid being force placed at all costs. So this is a great question, and I really feel for people. Listen, in my household, we're going through our third significant premium increase in just 5 years. And this was the first one that I was unable to beat by shopping it. So we're just grinning and bearing it and having to subsidize our escrow account. So great question. We're getting a lot of it, and I'm not sure what the outcome is going to be, but insurance definitely needs to be on everybody's radar. And that's what I mean when I'm talking about the fundamental core things to focus on, and make sure you've got enough buffer built into the payment to absorb those increases. Hey guys, you hear the music? You know what that means? We have wrapped up another week here at the Mr. Mortgage Show. Man, when you give me a mic and let me go, an hour flies by. I hope you guys had as much fun as we did. If you want to join us next week, we will be back right here. Same time, same station. If you need us when we're not on the air, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. One more time for the guy way in the back trying to write it down. MrMortgageRadio.com. All right, guys, have an amazing week. We'll see you next time right here. Same time, same station.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.